Cryptocurrency, blockchain, Bitcoin, Dogecoin, cold wallet, hot wallet, mining. What does all of this mean? We're going over Bitcoin, other cryptocurrencies, why they're important, and how you can get your hands on some if you're interested. Let's start at the beginning. Yes, dinosaurs. Dinosaurs instigated the creation of Bitcoin. No, just kidding. It's thought that after the US 08 housing and stock market crash, which brought global repercussions, a man that went by the presumed pseudonym Satoshi Nakamoto had the idea to build off of existing cryptographers and electronic currency systems. He used papers and research done around existing theoretical cryptographic digital currencies and published his findings in the infamous white paper called Bitcoin, a peer-to-peer electronic cash system. This was released in October 2008 after spending the previous year working on the project, released Bitcoin version 0.1. Fast forward another year and a half, and Satoshi Nakamoto faded away into obscurity just as fast as he came to prominence. Satoshi Nakamoto's story is almost that of a hero movie. This man single-handedly takes on the status quo of the current infrastructure of the financial system by building a currency alternative and starting a movement to transition existing methods of protection to a blockchain model to increase speed, security, and transparency. No one knows his true incentives. They're either personally driven, financially driven, or out of frustration with the current status of things. This video isn't specifically about him, but if you want to see videos about anything mentioned in this video, Cryptocurrencies will continue to be an ongoing series on the channel. Back to Bitcoin. The way it works is almost exactly how he designed it in his initial white paper. Bitcoin was the first cryptocurrency, this being a digital asset using a form of a ledger called a blockchain to record details of a transaction, such as the time, value, and parties involved. This information is set to a block that is then added to a blockchain. In a proof-of-work system, the current most popular way of computing the blockchain, miners use the computing power and the subsequent electricity to verify the authenticity of the transaction and to make sure it's not sent twice or missed. The miners mine the blockchain for a reward that is paid out in new coins as well as fees paid by transactions to make it into the latest block. This reward and fees are only paid out every 10 minutes after the block has been computed and added to the blockchain. Once added to the block confirms the integrity of all previous blocks back to the initial genesis block. This is to stop someone from changing previous transactions. An illegitimate actor can only affect so many previous blocks in the blockchain because of what we'll call a save point that are hard-coded blocks into the Bitcoin's code. Sometimes there are blocks that are mined at the same time and there's a temporary fork in the blockchain. Blocks are continued to be mined and the chain that is the longest becomes the main chain, and the previous blocks are just not used to verify transactions. Sometimes there's a hard fork caused by a different version of the code. This happens with most major cryptocurrencies, where developers of the code disagree with the implications of the currency, and both blockchains are continued to be mined, creating a new cryptocurrency with a different set of rules and instructions. For example, Bitcoin split into Bitcoin Cash in 2018 after a group of Bitcoin miners and developers wanted to expand the block size to allow more transactions, making it better to be used for everyday use rather than holding Bitcoin long term. Both versions of the blockchain continue to exist autonomously, duplicating the existing coin to a new altcoin offshoot that is now traded and the market value determined independently. Cryptocurrencies exist on rules established in the initial code that can only be changed by the majority of the open source community adopting the change. This change then has to be adopted by the mining community to avoid a hard fork. Bitcoin and most subsequent altcoins, coins that are not Bitcoin, are open source, meaning that anyone can access and copy the code, allowing for bugs to be found faster, as well as to allow more people to contribute, making the most updated version of the code. The initial rules determined by Satoshi Nakamoto for Bitcoin were set to create a deflationary decentralized currency that cannot be tracked or managed by any third party while eliminating fraud. To do this, he outlined a plan for the currency to become harder to mine over time, as well as to limit how many coins can be mined to stop anyone from producing a limited amount of the currency. The limited nature of the currency only allow it to go up in value over time, assuming the supply and demand are subsequently high. This brings us to why you'd want to own any cryptocurrency or crypto. Each crypto is designed with a different purpose in mind. Bitcoin was to be a decentralized deflationary currency, Ethereum's is to leverage the blockchain technology to be the future of financial transactions, and Dogecoin was to be a meme. There's an infinite amount of altcoins. CoinMarketCap.com tracks over 4,000 of them. They can be used to offer an alternative investment into a company called an ICO, similar to an IPO. They can track a currency such as USD or gold, or they can take on a completely different approach to an existing cryptocurrency. Right now, we're kind of in the wild west of crypto, since many of the cryptocurrencies' codes are open source. Anyone with technical knowledge can use it to create their own currency. Years from now, there will only be a few cryptocurrencies that will have the majority of use and value, while others will be tied to services or for specific purposes. Until then, people are really just betting which one they think will be the most widely adopted, since most crypto's price is controlled by a free market. The price is tied to the demand for it, and if you want to buy or mine some coin in its infancy, it could increase many times in value. But this can also be a problem. In early 2010, many people were coming out with their own altcoins and were pumping up the price and then dumping them on unsuspecting individuals and investors. This is called a pump and dump scheme on the stock market and is highly illegal. We're starting to see more lawsuits filed against people using such scams like John McAfee. This is something that's hard, if not impossible, to regulate, since many, if not most, crypto have no way to control the market behavior. Although, as coins like Bitcoin and Ethereum gain popularity, it takes more and more money to affect the price of the currency drastically. Sadly, that's not the only problem with cryptocurrencies. Something Satoshi even acknowledged in his initial white paper is that anyone that can take over 51% of the network can cause a double spend attack, which can be used to steal money or delegitimize the network. This may sound difficult, if not impossible to do, but it's not unheard of. Bitcoin Gold, a fork of Bitcoin, has already had 2 such attacks on its network. The first one estimated to have stolen over $18 million worth of Bitcoin. The way a 51% attack happens is someone computes over 51% of the blockchain, allowing them to cause double transactions or halt transactions altogether. This could be used to steal millions of dollars or cause destabilization and uncertainty of the network, causing it to lose value or even cease to exist. This will be difficult to happen to Bitcoin since the computing power averages around 150 exahashes, which is a lot of computing power. It's hard to quantify the scale of this computing power, but it's estimated to be more than the top 500 supercomputers combined. Most of this computing consists of pools, which I'll explain in our crypto mining video, but basically a pool takes a bunch of computing power and splits the mining profit. Currently 5 of the pools produce over half of the hash rate, and since a majority of the mining is done in China, it wouldn't be impossible for the Chinese Communist Party to nationalize those mining operations and take control of Bitcoin for themselves. The top 5 pools could even band together and create their own 51% attack, but this is unlikely since it would be against their best interests. They make more money from the price of Bitcoin going up and mining it than they would from stealing and destabilizing the currency. Most people don't bite the hand that feeds them, but we'll see what happens during the next hard fork of Ethereum. It's going to take away transaction fees and start the transition of the network to a proof of stake model that eliminates mining altogether. The last and probably the biggest problem is how people store their cryptocurrency. Unlike the US dollar, which is insured by the FDIC, aka the US government, up to $250,000 per bank account. This insurance protects you from theft, bankruptcy, or any other disaster where your money could just be taken away. There's no such protection with cryptocurrency. Since Bitcoin was designed to reduce the cost of transactions by relying on the blockchain to verify them, there are no protections when money is stolen or spent. This means that any transaction that's put through the blockchain is considered legitimate, no matter from who or to where it goes. This eliminates time and money spent verifying transactions, but also leaves the protection of the currency on the users rather than intermediate private institutions or governments. To protect your crypto, you can either store it in a cold or a hot wallet. A cold wallet is not connected to the internet and can only be accessed in person, either by a digital key, a paper print, or stored on an old hard drive. A hot wallet uses software that is connected to the internet to make deposits and withdrawals, but it also adds a way for thieves and hackers to steal your crypto. You could entrust your crypto to an institution such as BlockFi or Nexo, which will offer you interest rates for holding your crypto similar to a bank. But since there isn't much legal protections when using these companies, you should use them at your own risk. Back in 2010, Mt. Gox, a Japanese-based firm, had 850,000 Bitcoin stolen, and only 200,000 were ever recovered. This would be valued around $32.5 billion today. Mt. Gox was one of the largest Bitcoin holders and exchanges in the world at the time, but due to the lack of security, they quickly dissolved and declared bankruptcy. This wasn't the only case of Bitcoin going stolen or missing. Billions have been lost to people passing away, throwing away, or just forgetting their keys. So after hearing all this, why would you even want to own cryptocurrency? Bitcoin has soared from a low of $5,000 earlier this year to a high of over $61,000 just last week. For others, it's the anonymity, the bet on the future of currency, or the motivation that you control your money and not the government or an institution. These are all valid reasons. Cryptocurrency is poised to disrupt our traditional way of using fiat currency. It empowers faster transactions while also being cheaper and more freely accessible. The question is which cryptocurrency will prevail. Each one tries to make its own case, but because of the nature of crypto, the price is purely related to supply and demand. Many critics of Bitcoin see its ultimate demise from competing coins, doing what Bitcoin does better and faster. Others make the case that Bitcoin already has staying power due to the early lead it has and the support from its community of users, miners, and developers. Then there's Dogecoin. Recently, thanks to internet memes and Elon Musk, it's soared in price and popularity. Unlike other altcoins that are designed to change how cryptocurrencies approached or used, Dogecoin was designed as a joke. Most altcoins are derived from Bitcoin, Dogecoin being a fork of Lucky Coin, which is a fork of Litecoin, which is, again, a fork of Bitcoin. Dogecoin was really just to make fun of the altcoin craze of the early 2010s. The community in hand loved it, turning it into a crypto for good, raising money for charity and spreading positivity. Whether or not Dogecoin could be used as a legitimate currency is up for debate. Many speculate its lack of cap of how many Dogecoin can be created as an inevitable fault of the currency as it's mined for eternity, while others point to its yearly mining cap that can always be adjusted by the community of developers as a regulator for the price stability. If any of this has piqued your interest, you may be wondering how you can acquire cryptocurrency. Large investment platforms such such as Robinhood and Webull already have trading for large cryptos like Bitcoin and Ethereum, as well as cash management apps like PayPal and Square now supporting trading of the currency. Although it's recommended by most crypto enthusiasts to buy from a dedicated crypto broker like Coinbase or crypto wallets such as BitPay. They allow far more control over your crypto, such as the ability to store it in a hot or cold wallet if you desire. You may even be able to buy Bitcoin at a Bitcoin ATM or even at your grocery store. The future will really tell what lies ahead for cryptocurrency, but it's exciting to be on the forefront of technology. We might see a similar adoption shift from no smart devices to everyone having smartphones in their pocket in a matter of years. This could make the price of crypto balloon, as well as make an interesting future that was all started by an anonymous man that went by Satoshi Nakamoto. We'll see where this goes, but there's so much more to talk about crypto that I didn't get to mention in this video, like proof of stake, smart contracts, all the other altcoins, and how mining works. All these things we're going to be covering in future videos, so support the content, like, comment, subscribe. But that's all I have for this video. There'll be links in the description, and hopefully I'll see you guys very soon.